All right. So, good morning. All right, we're going to get started in a few minutes. So, just going to wait for anybody else that wants to join us to trickle in here. So, sit back and just listen to the boss for a minute, and we'll get started in just a second, okay? How are you doing today, Laura?
Hi there. I'm doing very well. It's been busy already.
Good.
How are you feeling?
I'm doing great, actually. Just
Good.
enjoying.
Last month you had a little bit of a cough.
I did. So let me turn this off. There we go. Yeah, I had a little bit of a cough, but it's all seems to have subsided now. So looks like we got a few
Okay.
more folks trickling in here. So I'll give it just another minute or so, then we'll get started. So all right. Okay. All right. Well, in the interest of time, it's 11:01. We may have a few more folks that decide to trickle in and join us. Obviously, if you're not on the webinar live, you still have the opportunity to register and watch it at a later time. Um, so I'll just go ahead and open it up. Welcome to the October monthly market update. And thank you for joining me. This webinar continues to be our monthly session to discuss what's happening in the global and the domestic markets and the economy, and to provide an opportunity to ask questions and talk about what you're hearing and seeing and how that might impact your personal finances and investments, both now as well as in the future. So, if you received the email invitation, you should have received the market update quick hits, which is a summary of. I'm going to move on to that. It's just kind of a summary of what has happened in the last month. So that's included in the email invitation. You're also welcome to watch the video blog post by Chris Fasciano, who is Commonwealth's chief market strategist. So that provides, in addition to this webinar, an opportunity to hear from somebody else about what's happening in the markets and the economy and how those might impact. But I do summarize a number of the different points that he covers as well. So just a couple of different resources for you to utilize. So let's get into it. I'm just going to summarize the market update and the quick hits for you. I'll talk about a few more of the details about what I think might be worth mentioning, and then I will open it up for questions. So the quick hit says the markets continued their upward climb in September, with the U.S. stocks reaching new record highs despite the month's historically weak reputation. Falling interest rates and stronger than expected earnings helped to fuel the rally, while economic data showed steady growth. Although some risks remain, the overall tone was optimistic heading into the final quarter of the year. And so beyond a couple of the bullet points is that stocks hit new highs as the rally extended into a fifth month. The Federal Reserve cut interest rates. We'll talk a little bit more about that. GDP has been revised higher and job growth is slowing. So we'll talk about that. And then obviously with the shutdown, we've got political gridlock and global tensions that are still kind of in the backdrop. So that's the monthly market quick hits. So to start off, as far as these charts are concerned, September was a good month. It was a good month to be an investor. All of the market indexes were positive for the month, hitting new highs multiple times, and mostly ending the month on a record, ending the month in record high territory, which is somewhat unusual for a month that has historically been one of the worst as far as investment months are concerned. So good performance in September. The S&P 500 ended up for the month 3.53%. The Dow Jones Industrial Average was up 1.87. The NASDAQ was up a whopping 5.61% for the month. And looking at international stocks, which is the MSCI, the MSCI was up 3.64%. And even the bond index was up 1.09% after the most recent Federal Reserve cut. So all across the board, generally positive returns for the markets. If we look at performance year to date, so the positive market train has continued to roll, even factoring in the severe drop that occurred in April. The markets have continued to show their strong growth for the year. As of the end of September, the Dow is up 9.06% for the year. The S&P is up 13.72%, and the tech-heavy NASDAQ is up 17.34% year to date. International stocks are up a whopping 26.64% from the start of the year. That's somewhat helped by the softening US dollar, and bonds even are up 6.13%. So all across the board, we're seeing strong positive overall returns for the year. So that's, again, good news for investors. Now, the market indexes are up primarily because companies inside these indexes have been reporting strong earnings. So over 80% of companies in the S&P, actually, I think it's closer to almost all companies have now reported their earnings, and over 80% of those companies in the S&P beat their earnings expectations, and not by a little, but by a lot. Overall earnings growth averaged about 13%, with year-over-year growth nearly doubling the expectation of 7% earnings growth originally forecast for the year. So that's the primary driver for the markets being up. Additionally, the bond market has also rallied on expectations of continued Fed rate cuts. On September 17th, the Fed cut rates by 0.25%, as the market largely expected, and that was primarily due to softening jobs reports and inflation reports that have showed that inflation, while not eliminated, has largely been checked to less than 3% year-over-year growth. I know they've got a 2% target, but I think they're accepting that anything less than 3% is probably a good starting point. So, in addition, the president has been pressuring the Fed to cut rates for some time. So, I'm guessing that the numbers are finally showing them that they can cut rates without leading to too much inflation. There's also an expectation that the Fed is going to continue to cut rates through the end of the year, potentially up to half a percentage point. There's a large expectation that it's going to be done in two different rate cuts of a quarter point each, but they could all do it all at once if they wanted to. So that's the expectation, and that's going to potentially provide some potential relief to the economy and those shopping for cars and homes. I will say one caveat. Oftentimes, people think that if the Fed cuts rates, that it automatically leads to lower mortgage rates, and that does sometimes happen. But 30-year mortgage rates and short-term federal funds rates do not always move together. So just because the Fed cuts rates does not necessarily imply that the mortgage rates are going to drop. They probably will. There's some easing; it does trickle through, but it does not. It's not necessarily a one for one. Um, the On the economic front, things have continued looking positive. Trade tensions have eased a bit as the administration continues to negotiate numerous trade deals. Overall economic output in the U.S. as well as globally continues to be reasonably strong, with the U.S. second quarter GDP showing 2.1% annual growth and an estimated 1.9% annualized growth rate moving forward. Not as large as hoped, but it's still positive. Okay. Um, I don't have I didn't get my slide on this, but the direction of the overall employment seems to be one of the biggest watchouts right now. That and the status of the current federal government shutdown. Unfortunately, because of the shutdown, the Bureau of Labor Statistics is closed, so we won't be seeing the latest jobs report until they reopen. However, we can still use other indicators to get an idea of the direction of things. ADP is one of the largest payroll providers in the country, and they put out a monthly report showing monthly payrolls report, and they put out a report recently that shows that the private sector payrolls declined by about 32,000 jobs in September, which is actually the first yearly decline since early 2023. Hiring declines have also been broad-based across multiple sectors, indicating slowing job growth across the whole economy. One of the other indicators is the JOLTS report, which shows the ratio of job openings to quits has declined from 1.8 a year ago to 1.3 now. So that basically shows that there are fewer job openings for those that are seeking work. It's not inverse. There's still quite a few jobs open, but it's not nearly as strong as it was a year ago. Also, speaking of the shutdown, I'm going to jump to the shutdown slide. The markets seem to be shaking it off. So we're now a week into the shutdown. The markets are taking it in stride, and surprisingly, that's generally how they have reacted, at least in the recent past. While these situations are frustrating to those that are working for the federal government and those needing to deal with a closed federal agency such as Social Security or other federal agencies, it doesn't usually have much of a long-term impact on the markets. Okay. So interestingly, we've had 21 government shutdowns so far, with the first one starting in 1996. So the slide I'm showing is what happened during the last government shutdown, which was in 2018 through 2019. That lasted 35 days. And as you can see, from the beginning of the shutdown to the end of the shutdown, the markets still continue to rise. So, and this gets back to my point that it's more about profits and how companies are doing rather than the how the government is impacting those. Now, I'm sure that if this shutdown drags on for longer than this one, or even further, it's going to continue to ratchet up the pressure, and it might have a negative impact. But for the time being, it doesn't appear to be. Okay. For what it's worth, like I said, we had 21 government shutdowns. The first one starting in 1976 under Gerald Ford. There were five under Jimmy Carter, eight under Ronald Reagan, one under H.W. Bush, two under Clinton, one under Obama, and now four under Trump. So it spans the gamut, and take that for what you will. The other thing that I wanted to illustrate, this chart shows the comparison of gold to the US dollar. It's been noted that recently gold hit another record high of almost $4,000 an ounce, which is amazing to think about. So protect that stuff that's sitting on your hands or your neck. A lot of that is driven by the softening of the US dollar. So the purple line is the price of gold, and the yellow line or the orange line is the US dollar, the index of the US dollar relative to other currencies. And as you can see, the drop off here, the US dollar has softened quite a bit over the last few months. Well, that wasn't the start of the run up in gold. The run up in gold really started a couple of years ago. And a lot of that is driven by concerns about the overall economy. Other things, it's seen as a hedge against inflation. We had a spike in inflation. So there's just been an overall interest in moving to gold. Gold often moves in tandem with energy prices, but that is not the case right now because we've seen oil prices soften a bit. So it's a little bit of a peculiarity as to why we're seeing so much of a run up in gold. Gold tends to be counter-cyclical to the markets, or it doesn't correlate as well to market returns. Although right now it does seem to be correlating quite a bit. So take that for what it's worth. Okay, so moving on to other things. So there's risks to watch. There's particularly foreign risks. It appears that we may be reaching an initial end to the Israel-Gaza situation. Fingers crossed on that. As for the Russia-Ukraine conflict, that doesn't appear to have any end in sight. A resolution to both would have a positive effect to both the U.S. and international markets and the economy. So let's hope that we get to some resolution soon on both of these situations. So to summarize, okay, September has been a reminder that despite what's going on in the world and politics, the markets are not always directly impacted by the things we see in the news headlines. So again, the primary driver for market returns is profit growth, and so far that has continued to be strong. But that may not last forever, right? The softening job market is something to watch. I'm not immediately anticipating any, crash or collapse or anything related to that, but we could see some economic softening in the future if that trend continues, and that would potentially lead to some softening in the markets. It's something that we're keeping an eye on. Additionally, right now the markets are at an elevated valuation level. So again, market growth is driven by profits. As long as profits remain strong, growth remains strong. If profits drop off, there's a possibility that the market will drop off in comparison as well. So, of course, these dynamics that we're seeing right now, as well as what we saw earlier in this year, serves as a reminder that investing has risks of loss. Has risks of loss, especially for the short term. A well-diversified portfolio that matches an investor's goals and timelines remains the best path for both benefiting from market participation while also protecting against excessive losses. So keep that in mind. All right, let me open it up for any questions or comments that you might have. As a reminder, all the questions should be relatively general and not particularly specific to anyone's personal accounts. If you have any specific personal questions, we can schedule some time to address those privately if you'd like. So, is there anybody that has any questions they would like to pose? Okay. Going once.
Hey, Landon,
Yes.
Jeff Hubbard.
Oh, hey, Jeff. How are you doing?
I good, good. Hey, I'd written a question on the initial signing up for this your webinar
Oh, I didn't
about
catch that.
yeah, it was about the all the interest in AI and everything. Should investing in AI tech areas, should that be increased with all the interest in AI going on right now, or should we just kind of just lay low and see what happens?
Well, I definitely believe that AI and some of the technological innovations that we're seeing in that space are certainly going to continue. A lot of money is flowing into those sectors and those particular companies. That's kind of one of the reasons why you've seen the run up with the Magnificent Seven, because those are the companies that are sort of leading in that space. I think that that is going to continue. I don't know that we're going to continue to see the level of concentration in those stocks, but I definitely think that we're going to continue to see additional advancements and growth in AI technology, and it's going to be broadened across the overall economy. So it's definitely a good, I believe it's a good space to continue to be investing in. Now, that being said, it is still early in. I know a lot of these technologies have been around for a number of years, but as far as the public is concerned, it's still relatively early. I mean, we've only actually had Chat GPT out for, I think it's less than a year at this point. So as far as the public is concerned, it's still a little bit early. And just as the same thing happened with the overall internet and web companies, there will be a shakeout, if you will, over time. So just invest with caution and a caveat that it's still going to be volatile for quite a while until the winners and the losers are identified. And that's part of the reason why you've seen the Nasdaq returns excelling beyond, say, the S&P 500 or the Dow, because the Nasdaq is more tech heavy and the returns in those sectors have been greater. So it's been weighting the returns on the Nasdaq more heavily than some of those other indices. So hopefully that answers your question.
Yeah, I did. That's kind of the same direction I was going. I just wanted to verify I'm doing the right thing, but
Yeah,
I
I
think
would say
that's
if you look back
pretty much
at
going that way.
2022, okay, tech got heavily punished. When we saw that drawdown in 2022, tech got heavily punished, as it usually does when there is a slowdown, but it also rebounds a lot stronger than the rest of the market as well. So that it has a higher degree of beta, as we will call it, volatility relative to the broader market. Okay.
Okay, thank you, Lennon.
Absolutely. All right. Any other questions? Hopefully, I didn't miss any other questions in the sign up. I'll be a little bit more diligent on making sure that I'm looking at those before starting this going forward. So, all right. Great question, Jeff. Appreciate it. All right. Well, if there are no other questions, you're obviously welcome to reach out to me directly and ask your question privately if you'd like, kind of one-on-one. We're going to do this again in a month. The next one is scheduled for Wednesday, November 5th at 11 a.m. Again, I'm typically holding these on about the second Wednesday of each month, but I do adjust based upon when the reports come out and when various information is published. So just keep an eye on the invitations as they come out. And always, if you have friends or family that you think would enjoy participating or hearing what I have to say, feel free to forward the invitation or the video for that matter to them. These video links are being posted to the website, so within a few days or a week or so of this webinar, the link to the video should be up on the website to review for future use. So we also have other scheduled webinars on various financial planning related topics. The next one is going to be, I guess I should move to this slide. These are the upcoming events. The next one is going to be on long-term care and end-of-life planning to be held in 2 weeks on Wednesday, October 29th at 12 p.m. Pacific. So, again, you can find my previous videos on various financial planning topics on our website under the events section under past events. So just click to watch the recorded video and you're welcome to watch those at your leisure. Okay. All right. With that, thank you to everyone who joined us at our annual pirate themed shred party this past weekend. It was a great success and we appreciate everybody that attended. Oh, yes. I'm sorry, Jeff. Go ahead.
I was just wondering, I have a friend that's also in investing and stuff, and he's not a client of yours. I'm trying to push him your direction, but is it, hey, yeah, whatever we could do, right?
Yeah, exactly.
Is it okay if I share your webinars with him?
Oh, certainly. Yeah. I'm always happy.
Okay.
Yeah, feel free to share with whoever you want to share with. And not everybody might agree with my opinion, but I'm happy to engage in a healthy dialogue about, investing topics. Okay. So feel free.
Yeah, he's the next one here, the long-term care and life planning. We were just talking with that about 5 minutes ago before I got on here.
So
and
timely topic then.
Yeah, so I might share your link with him for next week.
Certainly, yeah. Happy to have him join us. So okay.
Okay. All right. Thank you.
And so yeah, that is all I have for the day. If there's anything else, I wish you all a enjoyable October. Happy Halloween early. And we'll see you next month on November 5th for the next market update, as well as on the 29th for the webinar session on long-term care. So thank you everybody for joining me. Okay. Okay. All right. Thanks a lot. All right. I'm going to go ahead and end the video. All right.
Thanks, Landon.
Mm-hmm.